InFi, Episode 10.
Welcome to InFi, the Future of Finance, hosted by American economist and author Dr. Robert Murphy. Each week, tune in for dynamic discussions with business pioneers about emerging trends in finance, life insurance, asset management, technology, and more. Now, let's talk the future of finance.
Hey, everybody. Welcome back to another episode of InFi, the Future of Finance podcast. Today, my guest is Christian Hubbs, who wears many hats, but what we're going to be focusing on today is his expertise in both Mark Spitznagel's recent book, Safe Haven, where Mark goes, and I know Mark, and I actually reviewed some early drafts of his manuscript, so that's why I know this material quite well. He is a hedge fund manager who has a very unorthodox approach to risk management. And Christian Hubbs, who our guest is today for the InFi podcast, actually wrote several posts going through the material in that book, and then even including Python code and such to help his readers reproduce the results and really understand the material. So since the particular element from Mark Spitznagel's book that Christian was highlighting happens to be something I also thought was very important and used in one of the early white papers that I wrote for Infineo. See how it all comes together? It's like a Seinfeld episode. I thought, okay, Christian, why don't we go ahead and really drill down into that point? So that's like the first 45 minutes of the discussion. And then it's a completely different discussion following that. We talk about artificial intelligence and the applications specifically in the business world, which is, of course, another main thing that we have going on here at Infineo. So that's the reason I was really happy to have Christian as a guest, and we sort of hit both of those topics in some depth. So let me read to you his official bio. Christian Hubbs holds a PhD in machine learning and optimization from Carnegie Mellon University, an MA in Christian philosophy and apologetics from Biola, a Master's of Science from ETH Zurich, and a Bachelor's of Science from the Ohio State University. He currently works as an independent consultant and researcher in developing and applying AI/machine learning solutions for businesses. So it's a very in-depth episode. I learned a lot. I think you folks will enjoy it. If you are interested in what we're doing at Infineo, this is a great episode for you. Also, last thing I'll mention is you can certainly get by listening to the audio version of this, but in the first half, when Christian and I are talking about Spitznagel's results and how you model the financial performance of somebody using various investment strategies, Christian flashes on the screen some displays from his computer code. And so if you're watching the YouTube version of this, you'll be able to see that. So our discussion will be a little bit more sensible to you. But again, if you're just in your car listening to this, it's fine. You're going to get the gist of what we're saying. Without further ado, my discussion with Christian Hubbs. Christian, welcome to the InFi podcast.
Hey, thanks for having me.
So as I have alluded to already that the folks would have heard it in the intro I gave for this episode, you wear many hats. I had you on my own personal podcast for your work on Christian apologetics. And then when I was doing the intro for that episode, I saw your actual, day job bio and realized, oh, wow, this would be a great guest to have on the InFi podcast. So why don't we dive in first with, you wrote some articles talking about Mark Spitznagel's latest book on safe haven investing. And it's ironic because I consulted with Spitznagel on that book, and some of the examples that he went over, we used that in one of our white papers here for Infineo. So that's partly why we're going to be focusing on this one particular example of a game of dice, or a die game. It's a singular. And that's partly why we're focusing, because we use this as a springboard for one of our Infineo white papers. Of course, we'll put links to all the relevant stuff, folks, in the show notes page. But Christian, do you want to maybe just set the stage as to why it seems like it's a pretty simple game, and yet there's some counterintuitiveness going on in this example?
Yeah, that's no problem. So the way that this game works, that Spitznagel has put out, is you've got a normal standard six-sided die, 1 through 6. And each number corresponds to a payout. So if you are gambling and you're playing this game, you throw a 1, you lose 50% of whatever your wager is. So $1, your whole wealth, whatever it might be. 5% is what you get if you get 2 through 5. And if you get a 6, you get 50% returns. So when you look at this just at first blush, it looks like it's actually a pretty good bet, right? Because most people will take the mean of the returns, which is going to be your expected. So they'll take minus 50 plus 5 plus 5 plus 5 plus 5 plus 50, and then divide that by 6. That comes out to 3.3%. So that's your expected return. Now,
can I stop you, Christian?
Yeah.
Because this is so critical. We're probably going to folks spend at least 10 minutes on this. So I want to make sure we don't lose anyone. So the idea is like, if you have to put $100 to play the game once and you roll the die, if you roll a 1, then the person running the game keeps $50, so you're down 50%. If you roll a 6, then you get paid $50, so you gain 50%. So those two, intuitively kind of cancel out. And then in the middle, if you roll a 2, 3, 4, or 5, you get paid $5.
Yep.
And so you made 5%. So that's the sense at which clearly this looks like it's a game in the advantage of, that the player has the edge here. Or, a casino would never host this game because they would lose money.
Right.
In the aggregate. Okay, so now go ahead. But yet, it seems like this is a great game to play, but go ahead and continue, please.
Yeah, no, on first blush, it looks great. It's like, hey, I want to have this because I've got a 3.3% edge, when just looking at the expected average. What Spitznagel shows, though, is that the arithmetic mean that we're taking here, which is basically the standard average that everybody learns in grade school or middle school, whenever that's taught, of just adding the numbers and dividing by how the sample size. So adding them and dividing by 6 in this case is really terrible for actually calculating this. And that comes out to, again, that 3.3%. The reason being is that when you actually play this game, that minus 50% looms very, very large as a loss that can occur time and time again. And so his argument is that what you actually need is the compound annual growth rate, or the compound average growth rate, which is the geometric mean. And you get this by actually multiplying all the values together. And that comes out to, and then you can raise that to the power for however many times you're actually going to be throwing it. And you wind up getting actually a terrible return of minus 1.5% when you actually take the geometric mean in this case. And so
maybe let me try to give the intuition there too, just again, make sure we're not losing people. So here, what they're saying, like, suppose you played the game 6 times in a row, and every time you got one of the possible numbers. I mean, of course, every time you get one, what I'm saying, you get one of the remaining possible numbers you haven't yet gotten in the sequence. Is what I meant to say. And so if you start out with 100, you roll the 1, boom, now you're down to 50. Next, you roll a 2, you're up 5%, but it's 5% paid on the 50 because you're letting it ride each time. That's kind of the implicit assumption. So you don't get a full $5. You only get $2.50 on that one. And then if you roll a 3, you get 5% on the 52.50 and so forth. And then that last 6, you get the 50%, but it's not on the original 100, so you're not getting the full 50. And so the idea is if you played it and got all 6, sort of representative outcomes in a row, and you had let it ride each time, you would end up with less than 100. What did you say the loss was?
Yeah, so that in that case, that would come out to be $91.20. So with that, if you got everything in 6 rolls.
Oh, okay, so yeah, right. Because when you did the average, it was like per roll, and this is like 6 rolls in a row, so that's right. Yeah, okay, yeah. So over the course of 6 rolls, you're down $8 and change on average. And so notice that wasn't like we did some thing like, oh, gee, if you just kept happening to get the real unlucky one. No, we did there saying, what if you got each roll like when you would have expected it once out of every 6 times, and yet you'd lose. So the idea being it's this paradox. It's not really a paradox, but at first it's counterintuitive that the casino would not want to host this game because if there were thousands of people playing this day in and day out, the casino would clearly be losing money. And yet if you tracked any individual player longitudinally, if you folks know what that means, any one player, the longer he plays, the higher the probability that he's out of money.
Right. And one thing to note too is that the order that doesn't matter. So I could see somebody pushing back and say, well, you started off down 50%, but if you start up 50%, you're going to come out to the same result as long as that minus 50 hits within those 6 rolls. Because it's multiplicative. Like the order doesn't matter. So if you start up 50%, then you start off $150, then you hit that minus 50, you're at 75, and then you're compounding 5% off of that 75 for the next few rolls. And it'll come out to be the exact same number.
Yeah, and the way, and so folks, again, I helped in the consulting phase of this where Spitznagel had his draft, and I looked at an early version of it, and I was just boggled by this. And I was like calling my brother who's got a master's in math. And I was like, it was just, once I spent days walking around in a daze, DAZE, thinking about this because it was so counterintuitive. Yeah, the essence was so simple. I think that's why Mark focused on this, because it's a simple little game, and yet it unpacks a lot. And so one way I got my head around it was to say, like, exaggerate it. So suppose when you roll a 1, if you lost 100%, and suppose if you rolled a 6, you gained 10,000%. So clearly the arithmetic, expectation or mean of this, it would be a very positive value game for the player, and the casino would never want to host that because the people that hit, if they were betting roughly the same, would get paid a lot more than the people who were losing. So in the aggregate, the casino is going to be losing money. But any given player, if you keep playing this game over and over again and you keep letting it ride, that's the critical assumption. If you, at any moment you take your whole bankroll and let the whole thing go, if by this, the one I just tweaked and made it a new set of numbers, when you hit that 1, if you're down 100%, boom, that's it. It's game over. Even if on the other numbers, you can make them really high. And so you think on average. And so the idea being, like, if you had a team of players and you took your bankroll and spread it out all among them and had each person go and put, like if you had 100 players on your team and had each of them put 1% of your bankroll on it, that would be a good thing to do as a player to let, because then,
Right.
But what you wouldn't want to do is give all your money to one guy and say, play this game 100 times in a row and just keep letting it ride. That would be disastrous. You'd almost certainly end up in the new scenario that I made up to exaggerate it, with nothing. So that's kind of the idea. And then Spitznagel saying, if you want to model investing in the markets, clearly what's relevant is you playing a similar game repeatedly. That's more relevant rather than sort of like a million copies of yourself all playing simultaneously.
Yeah, and that's where he kind of diverges a bit from the traditional investing approach that looks at that expected value return. When you get that kind of mean variance, modern portfolio theory type of approach that just looks at, like, hey, you expect to get 3.3%, so this is going to be a good deal here. Another thing to think about with this as well, that at least helped me to really understand it, is that this is a compounding process. So it's a multiplicative process, as I had mentioned before. And I think that's why the geometric mean really makes sense here. Because if you think about it in the sense of, if you're just adding the results you get, so if you just have that number die 1 through 6, and instead of that being tied to a return that you're reinvesting, you're just summing those values, then the normal arithmetic mean is what makes sense there. It's going to be, that's what's actually going to be most relevant, because you're actually just adding the numbers. But in the case where you're taking your bankroll and reinvesting it, you have compounding effects taking place. And so that's where you have to actually use a slightly different mathematical value to understand what's going to be most relevant. And that's the geometric mean in this case, because of that compounding effect.
Yeah. And maybe one last one, just to really make sure people aren't getting lost. Imagine just flipping a coin. If it comes up heads, you gain 100%, you double your money. If it comes up tails, you lose 100%. You would, in one sense, that's a fair game, right? And, someone hosting that, I'd break even in the long run if I got thousands of people playing that, assuming, it's not that some people bet a lot and some people bet a little, and then there'd be, day. But if everyone's kind of betting the same amount, roughly, thousands, I'm going to break even if I'm the casino on that game. But from the player's point of view, clearly, you don't want to keep playing that game because every time you got a 50% chance of losing everything. And as Christian was saying, it just doesn't, once you lose all of it, you're dead. The fact that you earlier doubled, quadrupled,
doesn't matter,
so forth, your money just means that's how much more you're going to lose when you finally do get that devastating 100% loss. So if it's not literally 100% loss, if it's smaller, it's not as catastrophic, but the impact is still the same, that having, an X% increase and then having an X% decrease, if you keep doing that, you end up with less money in the long run. It's not that that's a wash, just the way these things work. And so having said all that, then what I thought was really interesting, Christian, is, and I know you go through this in your posts, Spitznagel then says, okay, so now with even this simple game, and we understand, like, oh, wow, there's this weird thing where the game, there's a sense in which it's advantageous to the player, like the expected, in terms of like a one-shot thing, there's an advantage. You expect to gain more dollars than you lose on any given roll of the die.
Mhm.
And yet, if you kept playing it sequentially with letting it ride, you're going to be losing money over time, almost certain probability or 100% probability that you're going to be down the longer you let that sequence go. And so what does that mean? You don't play it. It would seem weird to say the casino doesn't want to let anyone play, and yet no one wants to play. How can that be?
Right.
And so Spitznagel says, no, the solution is don't let it ride. And so do you want to speak a little bit about that, like the advantage of like staying somewhat in cash?
Yeah, and this comes to bet sizing. So if anybody is a trader or investor, you've probably come across, well, especially more on the trading side, the idea of your position size and how much do you actually put into any kind of investment. And there are ways to figure this out. There's one really terrible strategy called the martingale strategy, which is basically you continuously double up if you lose money. So you take $1, and if you lose, then you put $2 on the next bet. And if you have an edge, the expectation, just like you have here, of 3.3%, the expected value comes out to be positive. But you wind up actually losing your money over the long run as you keep on doubling and increasing your bet size to get that cash back because you're just over betting. So to get around some of these issues, people have come up with different ways to kind of hedge their position by remaining in cash and controlling their allocation. So you've got like the Kelly criterion, which came from signal processing with John Kelly working at Bell Labs, I believe, and trying to figure out, okay, probabilistically, we've got this binary signal that's being, or the signal that's being transmitted, and we can do some math around that and try to figure out what the optimal way is to get the signal, to reconstitute the signal. And it turns out that this actually works very well for gambling games as well, to figure out what that optimal bet size is, assuming you know what your odds are. And so that comes out to be pretty close, actually, in some of the posts that you'll link to. I show where this number comes in, and it's pretty close to the way that he sets up some of the stock market values, like a 60-40 type of split between investment in stocks and holding cash back. And the reason that matters is, and you alluded to earlier, is it doesn't make sense to put all of your money into this kind of game. But if you were able to spread it out and play it, give $1 to 100 different people or however you want to split that up to go play that game for you, or I guess in this case, 60 different people, give them $1 and go play the game. It actually works out well to be like an optimal bet. So you're always retaining some value in cash. So you never actually go and you hit that zero bound. You never actually lose everything because you have some money left over in reserve, and you're able to take advantage of that expectation on the other side. And so there's that. This gets extended directly into finance, into portfolio construction, where this is taken into areas of, okay, how do I actually set up a portfolio that I'm investing in order to ensure that I'm not over betting or overplaying my hand. I have some sort of diversification. I have some sort of cash, or I have some allocation to another asset that is going to maintain its value and actually ensure that I don't go bust over the long run.
Yeah, so great stuff there. Just to sort of repeat it back and make sure people are catching all those nuggets. So I don't know if you've read the original paper, Christian, but I went and I've heard of the Kelly criteria. When I was younger, I read books on like how do you count cards and blackjack and stuff. And so one of the things they said, like you said, an important element, it's not merely knowing, if you're talking about blackjack, for example, it's not merely knowing, on a freshly shuffled deck, if you have a hard 13 and the dealer's showing an 8, what do you do? Do you hit or do you stand? Yeah, you need to know that stuff, but you also need to know going into it, if I've been counting and I think the deck is, such and such in terms of is it advantageous or disadvantageous for the player, that I have a bankroll of $1,000, how much should I wager? Like, you need to know that too. It is certainly not that, if you've been counting and it looks like there's a lot of tens, that the deck is rich in tens now, you don't bet 100% of your bankroll just because you now have a little bit of an edge, because that's too risky. And so, and what they used in that book was the Kelly criterion, which again, folks, it's just a simple formula saying, given what you think your edge is, how much of your bankroll in terms of a percentage do you wager, on a given occurrence of the game or play of the game. And what's funny is the original paper, he just did that like as an example, because like you said, Christian, he was working for Bell Labs, and it was a paper about signal processing. And so just the example he came up with just to motivate it for the reader was to say, imagine, I think he was saying, imagine you're betting on horses, and that someone was at the track and like saw the winner and was like communicating that to you at an off-track betting place, like cheating, and
Mhm.
trying to give you but suppose that the cable had some defects in it, and so like the signal wasn't always perfectly accurate. So if it were perfectly accurate, every time you'd bet 100% of your bankroll because you know who the winning horse was before it came in. But he's
Mhm.
saying, suppose there was a small probability that actually, the signal got distorted. And so then he just set up as an exercise in this scenario, how much of your bankroll should you bet? So it really wasn't about gambling. It was about signal quality for Bell Labs. And yet, that little nugget that he did there was taken over by the finance profession to say, oh, wow, this is kind of a neat approach to use in terms of sizing your bets or you'd say risk management in terms of portfolio managers because they
Yeah.
don't want to make it sound like they're gambling. So
Yeah.
on this particular example, that I don't know if you have the numbers handy, but can you give it to show? So yes, you can play this die game, but the idea is instead of every time letting it ride, you take your bankroll and you just will let 40% ride or you let 60% ride? I forget which way it goes.
Yeah. So let's see here. Yeah, 40%. So I have all these simulations and such done. So one thing, if you read Safe Haven, is that Mark Spitznagel will just basically show the end results. And so in this series of blog posts, I actually try to break that out and show, okay, how do you get these numbers? And, what's the simulation? So that everything, there's Python code for everything. If anybody wants to check the work and see how to do this yourself. And I also did a couple of like little extensions in these. But yeah, so it turns out that 40% is roughly optimal. So 40% wager and then so 60% being held back. So I had that backwards in my head. And then we also show that for the 50th percentile. So that's the median case. So that's where most people are going to land, or at least 50% of the population is going to be either above or below that. So that's trying to get that median spot to say like, okay, this is the most likely place that you're going to wind up is going to be in this vicinity. But if you're a little bit more risk averse, we can look at that for the 5th percentile case. So then that means that basically 95% of the people are going to be that or higher. And we show basically what that comes out to be and so forth.
So just to be clear, you didn't do a pen and paper derivation here. You just you program the computer to do what's called a Monte Carlo simulation.
Mm-hmm.
And you had what, millions of iterations? I don't know what the...
Yeah, it depends on them because some of them were a few million runs because I would be simulating each setup about 10,000 times. And then you do that for 100 different ones. So that comes out to be about 1 million. And then sometimes I would do each one of those, another 100 times to average it out, to smooth it out, because sometimes you get a little bit of a, difference. So many
cases where, so in other words, it wasn't that you just ran the numbers and did the probability. It's well, in the long run, we'd expect it's that you actually simulated it and it had like a hypothetical person that play the die game. And so the computer had to randomly generate and say, oh, he rolled the die and got a 3. And the computer had to know there was a 1/6 probability and, have a way to come up with those outcomes, those, realizations of the die roll for each of these hypothetical plays of the game. And then you could step back and look at the aggregate performance and just say, out of all the simulated people playing this game this many times in a row, do you have the number? I don't want to put you on the spot, but do you have it handy to say, what if you just let it ride each time? And then what's the median outcome?
Yeah, let's see here. So that's the optimal bet size. I think I have that on the first example. Hang on, I'm just scrolling up here.
Just so we can show the people how changing the strategy affects what the median player's fate is.
Yeah. So if you just do it, the median case, you can get this one as well, just analytically by calculating it. But that winds up coming to a 90% loss or 99% loss. Sorry. So
that's how many times did they play?
If you throw it 300, if you play 300 times in a row.
Okay. So again, just to forgive me, Christian, I just want to make sure we're not losing people because you and I have studied this. So the idea is that the computer had people originally play that die game, again, where if you get a 1, you lose 50%. If you get 2, 3, 4, 5, you gain 5%. And if you roll a 6, you gain 50%. And had somebody play that 300 times in a row and every time take their entire bankroll and just keep letting it ride. And he's saying if you do that and you have lots and lots of hypothetical people run that, and then you survey the population of all such people who each played it 300 times, the 50 percentile outcome, meaning half the people did the lost, what did you say? Would you say it was 99%?
99%. Yeah.
Yeah. So half the people lost 99% or more. So like if they started out with $100, they ended up with $1 or less. That was true for at least half the people if you just let it ride each time. But instead of doing that, you say, whoa, that's way too risky of a strategy. Instead, guys, go ahead and play the game 300 times in a row. You start out with $100, but now each time you roll that die, you're only putting up 40. Well, at the beginning, you put up $40, not the full 100. And then each subsequent roll, you only put up 40% of what your bankroll is at that moment, and play the game 300 times that way. If you do that and you let tens of thousands of people do it, the median outcome is what?
Yeah. So the median outcome, comes down to, with the bankroll, it comes down to, hang on, I just got to scroll down a little bit on that. Oh, I had this written somewhere.
I think you even said it. It's just we forgot what you said.
Yeah. Well, I didn't. I know it's 40%, but I don't know if I said the actual precise value that comes out to. So it winds up 582% increase is what you wind up getting. So in your wealth by doing it, by actually betting optimally in this case.
Okay. So if you start out with 100, you end up with
negative 99% loss. Yeah. And then if you bet 40 and keep 60 in cash, that winds up coming out to a 582% gain.
Right. I'm saying, so for that case, I'm just trying to, so you end up, if you start with 100, you end up with 682 or something like that?
Yeah.
Okay. So so again, folks, that you see the disparate outcome. And again, that's saying for half the population ends up with at least $680 or whatever. Whereas at the other thing, it was half the population ends up with only $1 or less. So you can see there's a tremendous difference in the outcome. So what's interesting though, just to go back, because this was something too I was trying to get in what's his face? Kelly, in his original paper, had this offhand remark where he had a game, it was like you were flipping a coin, and if it comes up tails, you lose everything. If it comes up heads, you get triple your money or something. And he was saying, clearly you have an edge playing this. And he said the way to maximize your wealth and expectation is to just let it ride each time. And at first that surprised me, but it was true. Like the two statements are true. If you keep playing that game in the long run with probability 1, you will end up with $0. And yet the way to maximize the expectation of your wealth is to keep letting it ride. And the reason is because with each flip, there's a 1/2 chance that you triple your money or whatever I said. And so each time you play, like the probability keeps getting cut in half, that there's that one hypothetical guy who just keeps winning. And then if you played it 100 times in a row, that one possible path of outcome of just constant wins, that guy has like quadrillions of dollars. And then that multiplied by in terms of all the possible outcomes, is the way to maximize the expectation of your wealth. So it's just kind of showing why that's not really a good criterion.
Yeah.
Because,
I can actually show this, because I know we've got video here. I can share my screen. I can show one of these
that'd be great.
And just explain what this looks like.
I think the folks at home would much prefer that to me trying to say it.
Let's see here. Let me just do the entire screen, make sure I get the right one here. Okay. So here's the case that we discussed where we're not doing anything. We're just basically letting everything ride. And so what I have here on the left are those 10,000 simulated rolls of 300. And it's 300 because that's what Spitznagel used. So we're just using the same numbers that he used to show those results. And what you see here charted is basically, I just charted a single plot for the 5th percentile. So whichever guy came out to be the 5th percentile, you see that tracking here. So sometimes it looks good and then goes down. The median here in red are the 50th percentile, and then the 95th percentile. One thing that's really interesting about this, and that ties into what you were just saying, is the mean. So actually turns out to be really, really high. So this mean comes out to be a compound annual growth rate of close to 4%. And I think you're up like 19,000% or something like that is what this winds up coming out. So you're close to just under 10 to the 5th here. So this is on a log scale. So getting this precise number isn't possible really. But that's what it turns out to be to do tremendously well. And that's like dropping a billionaire in a room of people of 9,999 people who have, $0, and then one guy with $1 billion, the average in that room is now a net worth of 100K. And so that's why you get this big outlier here, even though hardly anybody turns out to be on this end of the scale, because it's so skewed. It winds up looking tremendous on average, because these are all very, very small numbers, very close to zero. Nothing.
And one way to get that right would be to take the 1.033 raised to the 300th power. That's what is generating that. Like, so saying on average, and when we said there's a certain meaning of the word average there, you gain 3.3% playing this game. And so, if you played it 300 times in a row, that would be great. And
right.
Yeah.
But if you were able to do that 10,000 times in parallel, and be able to spread out the money, then that turns out to be pretty good.
And then that's also, forgive me, Chris, but again, I was just trying to get my head around this. That's why the casino can't host this game.
Exactly.
Because from the casino's point of view, if there's thousands and thousands of people playing, occasionally someone will hit something like that or close to it. And so even though the average player, or even the, whatever it is, 85th percentile or whatever, end up down. Actually, can you eyeball that and see, like, to say in general, what percentage of the people end up down money? Is that something you can back out or interpolate from those lines?
Not quite. So 95th, you're coming out. This matches up quite nicely here, as you can see here. So I have it scaled. So you're basically just guessing at whatever the area here is on this.
Okay.
So 80% of the people lose money, something like that.
I think that's what I said. Yeah.
Yeah.
All right. So
exactly.
There you go. So so roughly speaking, 80% lose money. So that's the sense in which, some teenager wants to go play the game because he's like, Mom, I computed the odds and I have a 3.3% edge. And she says, no, most people lose. That's still true. So it would be foolish for you to sit there and play. Yeah. But the 20% who do win, among them, there's going to be a few huge winners, so that the casino ends up losing money overall.
Yep.
And that's why the casino's not going to want to host this, even though it's still true that nobody should just sit there and just let it ride 300 times in a row, because you're probably going to end up down money.
Yeah. And then if you look at the optimal, in here, we've got the 60-40 split with a 60 cash split. We have a lower mean ending wealth here that comes through. But now our 95th percentile outperforms, and we've actually moved into positive expectations. So we're above zero on our compound annual growth rate. And you don't lose very much. You lost some in the 5th percentile case, but you actually performed quite well, compounding over 300 times on the median case.
Great. And so again, the intuition there is the aggregate winnings are lower, that given that the casino has to have 1,000 players doing either strategy, the casino would actually rather the 1,000 players do this strategy, because the total losses to the casino are contained, they're low. But on the other hand, those aggregate winnings of the players are distributed more uniformly among the players. And that's why, in general now, this is a game that the quote average person, if we mean by that, like the median player, ends up winning, walking away from the table with more than he sat down with originally. And that's the way to reconcile these two things that at first seem contradictory, even though it's not a contradiction.
Yep, exactly.
Okay, so that's great stuff. Thank you. And the good thought of bringing those charts up so people can visualize it. And folks, what Christian's done here, like he said, in Spitznagel's book, he's got diagrams like that, but they're kind of a black box for you, the reader, whereas Christian, if you know Python code, gives you the actual programming. Also, Christian, just so you know, I ran that by our chief technology officer here at Infineo, Zuhar, and said, "Hey, is this like clean code?" And he goes, "Oh yeah, this guy knows what he's doing. This is very well written." So just so you know.
I hope so. Been doing it for a while.
Okay, so then the last thing, because I know we want to get onto the more exotic stuff about AI, but just the relation. So there it kind of shows like, how you can take a game and change your strategy, and then, in a sense, reduce the expected returns, but maximize or increase, I should say, like the long run performance. And then back in the sense of containing your risk. And then Spitznagel then even does an application with actual, like if you could buy insurance contracts. Can you use, if you don't have the numbers, that's handy, that's fine. But can you just speak a little bit about that principle?
Yeah. So the way that he does it is that he says, okay, so let's say that you pay a certain amount to be able to get insurance. So every time you roll a one, instead of losing 50%, you actually get a positive payout. Just like if your house burns down, you lost your house, but the insurance should come in and recoup that so that you're actually able to keep on going with life. You don't face this kind of terrible catastrophe. And so when you start to encounter insurance, you find that you can actually bet a lot more on it changes the equation, because now you're buying some insurance and then you're able to increase your bet size. And so you're able to actually recoup more because you're never encountering that catastrophic loss of losing 50% of your wealth or your bankroll that you're reinvesting into it. And so that winds up actually performing very, very well. I've got the charts here for this as well.
If you can pull that up, that would be great. Yeah. I didn't know. I just didn't want to put you on the spot because I hadn't warned you ahead of time.
No, it's fine. I've got all three of these pulled up, so I can just pop to them. I just got to do a little bit of scrolling up and down.
And while you're getting that ready, let me just the relevance to what Spitznagel's strategy is they engage in what's called tail-hedging, folks. And so the idea is in general, the stock market is expected to go up over time, but so it's a winning bet. It's advantageous to the player, but it's very volatile. On any given day, it could drop 40%. That has happened. That happened in 2008, where it came down, maybe not in a day, but in a very short period, dropped 40%. And so one approach is for people to do like a 60-40, I only have some of my wealth in equities and the rest in bonds, and thinking that's the way to contain my risk. And what Spitznagel and the people with his fund determined was, well, no, instead of doing that, it makes more sense to be 97% long the stock market and then have 3% in deeply out of the money put options on the S&P 500. And so that, if the market drops 40%, those options you bought explode in value in terms of relative to what you had to pay to get them. What's their market value in the scenario when the market drops 40%? And so that contains your overall bleeding. And it just works out with the numbers a lot of times that's a much more cost-effective way to hedge yourself than to just, leave 60% in cash. And so that's kind of the intuition of this.
Right. Yeah, exactly. And so what winds up happening here is, you wind up getting a much higher compound annual growth rate. I think for the last one, we showed 0.64, and now we're over 2% for the median case. And the other thing that we've noticed here, this is the break even on the histogram, the 0% line. And we've got, I think I said 0.2% finish in the red. So by putting some insurance, and then here he's got 9% of his bankroll on the insurance and 91% in the betting onto the bankroll. And so now almost nobody loses money. You're very, very unlucky if you wind up losing money with this kind of setup. And you're much more likely to actually make quite a bit of money. And the way you set this up is that you get a payoff of 6. So it's basically break even with the insurance contract, because if you lose you buy it every turn, or every time you roll, you have a 1 in 6 chance, the insurance company is basically breaking even. And in theory, you're breaking even too, because that's only going on the arithmetic mean perspective of it, because you're going to basically pay out your premium in order to get paid the exact same amount. So at the end of the day, everything should net out to be roughly zero between you and the insurance contract. But on a portfolio perspective, that winds up giving you quite a bit of gains.
Okay, yeah. So just to paraphrase what you said there for the folks at home, Christian's saying, for this particular example, just to show, to open up your mind to the possibility of, instead of just leaving a bunch parked in cash, which in this example means literally earning 0%, and the other 40% riding on this game where you've got a 3.3% edge, instead put 91% on the die game, you let that roll each time, and then you buy insurance. And for this example, just to keep the math cleaner, Spitznagel assumed that the insurance, the price of that contract is actuarially fair, that the insurance company is just breaking even in the long run with millions of people buying these contracts. So in the real world, of course, insurance, they do earn something. The insurance company charges you a bit more than the actuarially fair amount. But still, as everyone can see, the difference in performance here, it makes sense to buy fire insurance, even if, quote, the insurance company is making money off of you.
Right.
And the same thing carries over to this kind of example where you can see how the whole mass of probability got pushed up above that break-even point, except for the 0.2%. So even if the insurance was pricier, then still that would shift everything down a little bit. But in the grand scheme, you're still going to do a lot better with that strategy than even with the, keep a lot of money off the table strategy.
Yep. Yeah, and you wind up actually really only making money on the 50% returns. So this is why you have these kind of long drawdowns, where you're getting lots of 3s, 4s, 5s because you're paying some money into insurance. So you're really not making a whole lot of money until you get to those series of 50% type of returns. So it is really kind of an explosive upside type of portfolio or type of strategy.
Yeah, and also, folks, just so you know, in case you realize it's not just a theoretical curiosity, but in the real world, Spitznagel's Universa fund with Nassim Taleb was an advisor to it. They originally had their own fund, and then they shut that one down, and Spitznagel opened up Universa. They, in practice, when like the housing market crashed, and then with the pandemic crash, their fund had like 4,000% plus returns or something in a couple of days. So the idea is that they did very well for their clients, the people who got into that and realized, oh, the way I want to hedge my overall portfolio, this exposure to black swans, if that's the way you want to describe it, is using this approach. And so that's partly what's going on there. And I'll put a link that I reviewed a book talking about that. I know, Christian, that's part of what you did in your post. So we'll link to all this stuff, folks, if you want to see some of those details. But again, my point is, this isn't just a theoretical possibility. In practice, Spitznagel's fund has profited greatly from this approach.
Yeah, and that's what we kind of get into in the final post, because this is a 3-part series that I had done, just kind of breaking down the book. And the final part is like, okay, how do we actually apply this to the S&P 500? And so actually try to simulate it and figure out what's a cost-effective strategy, and how do you relax some of these assumptions, make some of these assumptions a little bit more stringent, and see if we can try to apply it to a real world scenario and all the data and everything to back that up.
Okay, so what is that chart showing us?
Yeah, so this right here is showing us the optimal bet size with insurance. So one thing just to note is that basically anything that drops down here, again, log scale, is going to be losing money. So you're actually very tight in how much you can bet, you can wager on this. So this is all about 91%, give or take, is going to give you the optimal bet for the 95th percentile case, the 50th, and the 5th percentile. So if you want to be very risk averse, you try to optimize for the 5th percentile case. So that way, if you get very, very unlucky, you still come out, doing pretty well, rather than the 95th, which, that's kind of swinging for the fences there. And 50th is the median. So I have these types of plots in there as well, just showing kind of where that optimal point is. And then, you can look at it over however much you want to actually put into the insurance, or how much you want to wager versus insurance. That balance, it drops off pretty precipitously. So you're losing money on insurance. And so this is where, we kind of get into that discussion about modern portfolio theory, and Spitznagel and Taleb also. They have this challenge against modern portfolio theory and modern finance, saying that, hey, we can use insurance to actually increase our expected returns, which is something that typically is looked upon with a lot of skepticism within the modern financial world, that is based on, Markowitz and Fama and some of the other people who built this intellectual edifice over time.
Yeah, right. I'm sure the listeners are at least vaguely familiar. A lot of this came out of Chicago School, CAPM. You may have heard capital asset pricing model, things like that. A few Nobel Prizes or Nobel Memorial Prize in economic science. It's not literally a Nobel. Alfred Nobel knew what was up when he's endowed these prizes. So the idea being, the baseline assumption, just to get the ball rolling when you start doing modern portfolio theory analysis, is to say, it's the mean variance thing, to say, oh, let's assume investors, when they're considering holding assets, yes, other things equal, they want to have a higher expected return, but they also want to have low volatility or a low standard deviation. And so, when you interact those two things, so if you had two assets and they were otherwise identical in terms of the expected returns, but one had a higher volatility, you would expect investors would sell that one off and go buy the one with the lower volatility, but then that would change the expected returns.
Right.
Because, the one they sold the price would go down, so the expected return would go up and vice versa. And so you would expect, so the idea being that, and that's why it kind of makes intuitive sense. Oh yeah, so the stock market, you'll probably make more over the next 50 years in the stock market, but on any given day, you don't know what your principal balance is going to be because it's so volatile. Whereas you go put it in fixed income, your expected return over the next 50 years is lower, but hey, it's safer. And so that's why if you're an older person retiring, you maybe want to shift more into fixed. And that's, so it's not an insane framework, but yeah, one of the sort of bedrock assumptions is that if you want to reduce your risk, you have to be willing to tolerate lower returns. And so as Christian is highlighting here, one of Spitznagel's, he opens up his book challenging that and saying, no, what we're trying to do is increase our return. We want to adopt strategies that increase our long-run calculated return.
Mhm.
And the way you do that is by reducing your risk. Because as we saw in this dice game, by reducing your risk, by shifting into the 60-40 split, for example, if that's the only option you have, to either let it ride or do that, to say, oh, I reduced my return. No, you're increasing the probability that you're going to be up money 300 rounds from now. So yes, you reduced your risk, and by doing that, you avoided or reduced the probability of catastrophe, and hence that's why your future self is more likely to have more money now. That's kind of the idea.
Yep. And I think it goes one step further than just reducing your risk, but they're actually including an asset that has a negative expectation and showing that they actually get better returns by including something with a negative expectation. Because when you actually take the average, again, using the arithmetic average, which a lot of the modern portfolio theory is based upon using, they wind up getting, oh, hey, you expect to lose money on this, but yet your portfolio does better. That shouldn't happen.
You're saying the insurance side contracts?
Right.
Okay, yeah. So let me just, for the folks at home. So again, the idea being, you put money into the stock market or in the die game, you're putting money on the die game, and then on the side, what if there's an insurance company that says, hey, every time you roll a 1, we'll pay you a certain amount of money, but the amount we're going to charge you for this contract to keep it in force, if you run the numbers on that, it's like, oh, the insurance company's going to make money from me in the long run. So like there's a negative expected value of me buying that insurance contract.
Mm-hmm.
And so one might think, whatever it is that this investment in the die game's doing for me over here, if I then supplement it with this other strategy that on average loses me money, how does that help me? And yet it does. And obviously it's because, it's the correlation that when you need it, the insurance kicks in and helps contain the catastrophic losses. And what's critical is when you're allowed to re-optimize. So it's not just that you're doing whatever you're doing with the die game and then as a side thing, it's knowing that you have that insurance contract in force that gives you the freedom to be more aggressive with the die game because when those catastrophic ones come up, you have the hedge in place. And so that's partly the interaction too, why, and they do examples like this too, Christian, but not just in Spitznagel, but in general, like merchants sending stuff in ships across the ocean once insurance got up and running that allowed, you know what I mean? Like in other words, if there was a chance that pirates or a shipwreck or something was going to take out your fortune, you would be reluctant to send a lot of expeditions across to the New World or whatever. But once modern insurance was up and running as an institution, then people would be more willing to do it because they're spreading and so that allows for greater wealth creation and that kind of stuff. So just all dovetailing with, hey, insurance is kind of a cool thing. And obviously here at Infineo, we're big on that.
Yeah, it's a big deal. So it changes a lot.
Okay, so we spent longer on that than I thought we would, but I don't think we wasted a second of it. Let's now shift to, you are an expert. You've literally got an advanced degree in artificial intelligence. So can you maybe just speak a little bit about how did you get into that? And then I'm going to probably ask you for some greatest hits from the industry.
Yeah. So I started getting into AI in 2016 or so. And this was really, I was brought into it. I was kind of working in the data science area, focused on supply chain for a large Fortune 100 company. And AlphaGo, which was an incredible achievement by Google DeepMind, was published. And this was basically where they had taken a computer system, an AI system that is based on a technique called deep reinforcement learning, and they beat some of the world's best in the game of Go. And the game of Go is like, people often make the equivalent of like a Chinese version of chess because it's very popular there, but it's actually much more complex because there's just a lot more state spaces. And so many computer scientists and so forth thought that we're probably about 20 years away from being able to have the kind of deep blue moment that chess had against Garry Kasparov in whatever, 98, 96, whatever that.
It was late 90s. I don't remember what year, but yeah.
Yeah. In the late 90s.
And just for people who don't know that was the classic, like, that was humanity's last stand in terms of chess against the machines. Right. Okay.
Yeah. And so then, we were talking 2016, they thought, hey, it's still going to be another 20 years before we were able to do the same thing in Go, just because the computational space is so massive, on the order of like the number of atoms in the universe type of thing. And so DeepMind was able to actually do this by using deep reinforcement learning, which is just a way of using AI systems to be able to learn through playing the game and getting feedback and updating this large deep neural network. They have some Monte Carlo tree search and some other techniques that they incorporated as well, but it beats Lee Sedol in 4 out of 5 matches in the game of Go, who was, I think, like the 18-time world champion. And then they beat the reigning world champion, Jie out of China the next year, who was like some 19-year-old, wunderkind in this in this field. And so this really opened my eyes into some of the problems that I had been dealing with in the supply chain space. And so I thought, hey, let's figure out how we can try to apply these techniques into just making a lot of these operational research, operational management decisions. And so that's what got me into it.
Can I stop you, Christian? I'm just, because I'm fascinated by this stuff, because I remember when I checked in with somebody like in, I don't know, 2007 or something, because I had been, in the 90s, I had been following, with Deep Blue and all that stuff. And then when there was a big head-to-head, and then I went to grad school and whatever and got sucked into economics and life. We had a baby and whatever. And I kind of just felt, and then I got reconnected with it. And I was like, and I asked somebody who knew this area like around 2007 or 8, like I said, oh, at this point, I mean, can computers, easily beat the world champion in chess? And he was like, your phone could beat the world champion in chess at this point. You know what I mean? Like, it was, in the 90s, they had the big supercomputer mainframe or whatever, but just the advances in computer, of course, like, the humans don't stand a chance against people. So you were saying it was the deep reinforcement learning. Do you know, like, how did they try to program computers to play Go beforehand? Like, what was the innovation in terms of, like, they used to do it this way, but now they were able to do it this way in terms of training it?
Yeah. So I know David Silver, who actually led the DeepMind team, he did his doctoral thesis on the game of Go. And it's been a while since I looked at that. I think what they primarily did was...
Should I go ask ChatGPT?
Sure, yeah. No, but if I recall correctly, it was a tree search type of approach. So,
okay.
And this is where you're trying to enumerate the future states.
Like just brute force.
Right. And you can only go so far in that type of approach before you just run out of memory, you run out of computational capability in order to search quickly and so forth and figure out what's going to happen next.
And I don't know, is there like a time constraint? Like, obviously in chess, there's a time constraint. So that's part of the issue here too, that it's the computer has to come up with the move. Like, if I had an infinite number of time, I could play flawlessly.
Yeah.
But okay. So they used to just do a brute force, and then the issue is Go just had so many more possible future states of the board that were legally conceivable, that just considering every ramification. Well, what if I make this move and look down the future possibility? You just didn't have time to search the state space, and that's why humans could beat Go up through 2015. But the DeepMind. So what did they do instead of just doing the brute force? How did they sort of take shortcuts? Or I don't know if that's the right word.
Yeah. So by using deep reinforcement learning, it's basically this approach that comes from the confluence of computer science, psychology, and economics kind of coming together to say, hey, this is somewhat like how animals learn, how people learn by getting feedback. And so what you'll wind up doing is you'll have a game of Go and or whatever you're trying to optimize in this case, and it will play step by step by step, and then it gets to the end and it gets a reward. So in a game of a Go, it gets a reward of 1 if it wins, a reward of -1 if it loses, and 0 if it ties. And so it will, through some mathematics derived from the Bellman equation and so forth, it will figure out how to actually try to assign that the positive that reward, the positive moves and the positive game states. And over time, after doing millions of training iterations, it starts to learn and get better and better and better. And it's able to figure out, as it explores this state space, what's actually a good move in these different situations. So it's not an optimization type of algorithm in the strict sense where it's going to find the global optimum in such large games and know exactly the best thing to do, but it winds up performing very, very well because it's semi-optimal if you want to be strict about it.
Yeah, I mean, because I read books from the library back in the day, like how do they program computers to play chess and stuff, because I was really into that stuff. But I like computers and chess. And I knew, like, back in the day, it was sort of a mixture that especially in the 90s, they couldn't have the computer consider every possible future state, as opposed to like tic-tac-toe. Like that's why in the movie War Games, the computer's never going to lose tic-tac-toe, because it's easy to just look ahead and see every possible outcome and make sure don't ever go down a path where the other player could possibly do a series of moves that you can't stop and prevent a win. And so, but with chess, there's just, there were too many to go through all those possibilities. And so they would have, expert chess players consulting with the team. And I even think I read that, like, with Deep Blue, they said something like, it's not so much that they programmed this computer that was really great at chess, it's they trained it to beat Garry Kasparov. Is basically what they did, which is a good enough, that's impressive. I couldn't beat Garry Kasparov in chess, but that's kind of, what I mean? Like, they were feeding it, basically training it on all of his past games or whatever. And so it wasn't so much the perfect chess playing machine to date. It was more like, this thing has been optimized to know how to beat this one human in chess. And so it's just interesting to see here how they're doing it. Like the combination of, the humans giving feedback, but also letting the thing rip. And then did I understand too, the idea that the engine has two versions of itself just playing each other head to head, and that's how it can crank out and just get a lot more experience than just like humans training it per se?
Yeah, and so that was some later iteration. So what they did initially was just train it on a lot of historical Go games, and then they had it play some former world champions and others to get up to speed, and some high level players. I think they use Dan or Don for the ranking system. And so they would take some of the top players and play it to get it ready. But then the later iterations, it was actually self-play. So they would have the systems play one another. And so they would both start off being terrible, where, a 5-year-old could beat them, maybe. Because it was just basically doing things at random. It doesn't know really what to do. And then as one starts to get a reward, then the other one, is able to figure it out and so forth. And so they start to compete. They're able to train much faster and do this all in simulation. So in a week or two, you have a couple of, super powered Go AI systems that you can play against. And it's able to beat, the old systems. And then they expanded this same sort of approach so that these models could beat, the Go and chess and, whatever other board games that were out there. And then they extended it to video games. So there was a game called StarCraft 2 that they had won. OpenAI did something with a game called Dota 5, I think, which is apparently a very, very popular. I'm not much of a gamer myself, but so it's a very popular online game with players running around the map and being able to do magic spells and whatnot to destroy the other person's base. And so they were able to beat some of the world's best teams in those types of complex environments as well, beyond just the board games. So now you've got some stuff where it's working in these dynamic arenas, and it's able to dominate human capability in those areas.
Okay, yeah, this is fascinating. So let me ask one more about the Go thing, just because I love this stuff, and maybe some of the listeners do too. So is the idea that, like, you're saying, like, they can take the primitive systems that have no a priori knowledge. I mean, they know the rules of the game or whatever, and they understand the reward function that, yes, when you win, you get +1, when you lose, you get -1, and a tie is a 0. And they let them just go at each other head to head. And so it's like, there's not much wisdom there initially, because there's no master involved who's teaching them the ropes and giving sort of rules of thumb. They're just trying anything randomly. It's like really terrible stuff that if a human master were teaching an acolyte, would just say, oh no, you don't want to go down this path. I'm just, trust me, this is what you want to do in the opening stages of the game, and give them a set of principles to follow. So they don't have any of that. But on the other hand, they can just play 1 billion games a week or something and gain knowledge that way. But you could still imagine, if that's all they did, they might be optimized locally in their own universe of other AI systems, but then when a human master comes along, it just blows them up because he's doing stuff that they never happen to randomly encounter in their simulations. But then even so, they would learn from that experience and then come back prepared.
Yeah, you could imagine that kind of situation. And so what you wind up having to do when you train these systems is balance what's known as the exploration exploitation trade-off. So if you know that you have a good reward or a good move, how often do you actually take that versus try something else? And so there's some ways to get around that and to balance it. So you're never necessarily exploring all states. So you're never provably optimal. At least with the current state of the literature, as far as I'm aware, I don't think there have been for policy grading approaches and so forth. Some Q learning, some simpler stuff, you can actually prove that it's optimal. But for most complex systems, you can't actually prove that it's optimal. You're just able to show that, hey, this is doing a lot better than what we had done before. And if you have some sort of benchmark, which the nice thing about Go is that you do have other systems that have been developed and they are rated, kind of like in chess, you have your ELO score, I think is what it is, your ELO rating to see how good you are. And it's pretty well established. Go has their similar rankings and has computers that have and programs that have similar rankings. And so you're able to benchmark pretty easily against those systems and say like, hey, let's take you out a simulation, go play this computer, see how that goes. And then go back. And so you're able to see how well they perform, as well as just being able to see how well they perform against, the previous versions of AlphaGo and so forth to be able to benchmark its performance.
Okay, great. All right. So forgive me for indulging myself there because again, I used to dream of programming when I was a kid playing this stuff. So I wanted to be you when I grew up, basically, is what I'm telling you. You and Richard Feynman. So now though, so this is what got you into this stuff. What you said, you weren't a gamer yourself. You're over working for a serious company. And then you started incorporating some of these techniques into chemical engineering. Is that the way to explain it?
Yeah. So I was working for a large chemical company, and they had moved me. I was living in Belfast at the time at one of our tech centers over there, and wound up getting the opportunity to go do my doctorate at Carnegie Mellon, focused on optimization and reinforcement learning for, in particular, supply chain issues within chemical engineering, chemical decision processes. And so how do we improve our decision-making within the industry and using this kind of approach? Because there are a lot of traditional approaches, and my advisors would be upset about this, but because they developed a lot of these, they don't get used so much in a lot of these cases where you're dealing with market demand and market fluctuations, because some of the assumptions that you have to make the problems tractable, they get blown up, kind of like connecting it back to our finance talk earlier, making these assumptions about Gaussian distributions and so forth to make it easy to be able to solve the problems winds up getting you into these corners, because your model will optimize and say, okay, well, if everything's Gaussian, everything's well behaved, and go do this, and that'll work 98% of the time. But then sometimes it gets into just really bad situations where, hey, the prices of whatever commodity or whatever chemical you're dealing with blow up one way or the other, or your supply chain gets all clogged up because of a boat stuck in the Suez Canal, and now we can't get anything.
Right.
Stuff that happens in the real world will throw everything off base because you're basing on all these assumptions, and so now you have to try to figure out how to do it. Not to mention, when you start to try to take a lot more realistic assumptions, then you have to try to restrict the search space that these algorithms will wind up doing to find the global optimum. So if you're familiar with linear programming, or in this case mixed integer linear programming or mixed integer nonlinear programming and so forth, as it starts to, when it gets to be stochastic, it becomes a little bit more difficult to handle some of those assumptions, because then you get to that branching factor becomes very large. And so sometimes if you get the optimal solution or something that's good enough, oftentimes you might have to wait hours or days to get the results, depending on how large the problem is that you're trying to solve. So there are some ways to get around this, but as you get around this, you start to move away from optimality and so forth. And so there are trade-offs involved everywhere you go.
Mm-hmm. Okay, let me try to distill back some of what you said. That in certain areas, not just in finance, but also in supply chain management and things like that, real world companies, household names that the listeners would know, pre 2015, they were using techniques that basically, if you drill down to like, what's the theory behind this? Whereas like they knew, hey, there's uncertainty, things can happen and we got to be ready and have a robust strategy. But they kind of assumed the shocks would follow, you said Gaussian, like a bell curve, a normal distribution, so that, the more extreme the event, the probability of that and the tail ends of the distribution gets low really fast. And so it's kind of like, as long as what your strategy is makes sense 98% of the time, you're probably fine. And there's 1% on either end of the curve, but who can? And no, because there's situations where that's not a good idea, because those rare outliers actually aren't as rare as your model assumes, and they can have a big deal. I know Mandelbrot, so folks know, like the guy who pioneered fractals, and you may have seen like the Mandelbrot set is a cool little thing on YouTube. You can go look at visuals of that. He wrote a book. What was it called? Markets Misbehaving?
Misbehavior of Markets.
Misbehavior of Markets. And he was going through and just showing, like, I forget the numbers off the top of my head, but over the last 100 years, there were a small number of days in which like the total moves in the market were concentrated. So it was kind of like you having your portfolio in place and blah, 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 and I'm hedged and I got this mixture and stocks and that if you didn't get it right on just 8 days over the last 20 years, then you got crushed, that kind of a thing. And just to show that the normal approach of financial economics and whatever and mathematical finance, they made these assumptions like Christian was saying, because you couldn't solve the equations otherwise. Like, we got to assume it's a Gaussian distribution of these shocks, because otherwise the math gets really complicated and choppy or discrete. So anyway, that's kind of where they were coming from. So am I getting what you're saying, Christian? That that's kind of the situation, but hey, what else could they do? But now with some of these innovations in AI, it's allowing us to do a more realistic modeling of our actual situation and coming up with at least approximate solutions.
Yeah, so there are a number of different trade-offs that they wind up making, because you wind up having to do approximate solutions with these. And in some areas, like the MILP type of framework, mixed interlinear programming, I don't want to get too much in the weeds, but like it works really great, because like if you have say a production process that's well controlled and you understand it, and it's all just basically physical processes, brilliant. Like why bother changing some of this other stuff, because it's just really not like, do you need to try to plan for an asteroid coming through the through the roof or some out there fat tail type of event. But when you start to move farther away from those well controlled environments and into something like supply chain, where you have different partners working together and you have bottlenecks and congestions and so forth, that's where it starts to break down and you have to make some simplifying assumptions that are very hard to maintain and in the face of reality, but also those models become very difficult to maintain as well. So as things change and things become a bit more dynamic, you need somebody or a couple of guys with some PhDs from MIT, Stanford, Carnegie Mellon type of places where this stuff is taught, to be able to actually go in and figure out how to update these models, because they're very, very complex, very math heavy, very, very difficult to work with and to solve. So they start to be, a lot of companies just wind up not using it once you get into those realms as well. And so with my background, because my first role in this company was actually, I got into the rotational program in Europe where I was. And so my very first role was, you don't know anything about supply chain. Sure, you've got a master's and good background in a lot of the stuff, but we're going to put you right in the hot seat of supply chain so you can learn it, which was great because it exposed me to a lot of these problems. And then when I was able to, start digging into like, man, this is just really a math problem. How do people solve it? Oh, they have these kind of different techniques. They don't really work. And then when the AI systems came on, it's like, that can do it. We can figure that out. And so then I did my doctorate with the backing of my employer at CMU to be able to go into this stuff and figure out how to really get your hands around it and try to apply it. So as far as I know, it's starting to now get it. We got something actually up and running within our company and got some proof of concepts and everything going, and it was running great. But it's still very early days. A lot of these techniques still just aren't widely understood and out there, because even within the AI craze right now, you're seeing a lot of focus on natural language processing. So
Right.
ChatGPT type of stuff, or video developments, mid-journey, generative AI, stuff like that. The area of my specialty of reinforcement learning and optimization is a little bit different. And that has a lot of great applications to supply chain, to robotics, to other things like that. But it's just, it's a bit more obscure of a niche.
Okay, yeah, I'm glad you made that distinction because I think in the public's mind,
It's all the same.
AI is the same thing. It just means ChatGPT or whatever. Or
Mhm.
maybe if they're really sophisticated, they know some of the competitors, but that's what they think AI is. Like, oh, can the computer pass a Turing test or something? But you're saying that, well, no, there's a lot of other things, like AI is revolutionizing industry, not just in terms of coming up with software that can simulate a human conversation.
Right. Yeah. Some of the same techniques are used,
Right.
and same mathematical frameworks, same programming languages and frameworks and so forth. So there's a lot of overlap, but at least the end use and the end application is a little bit different, and different from what you see in the public discourse.
Let me make a statement and you tell me if it's true. Is a common thread throughout all this, though, like the idea of maybe, I don't know if neural net's the right word, but like with the chat GPT, it's not that a bunch of linguists got together, they called in Noam Chomsky and all these guys, and they said, oh, here's how language works, let's program that into the computer. That's clearly not what happened. It just optimized with probabilities, and it was just like this, I think, trillions of parameters that they optimized by training it on the internet and to see like how English is spoken, how German is spoken. And so, like, if you understood under the hood what ChatGPT is doing, it's astonishing that it actually seems to work because it's so, unthinking and dumb. Is that, when you say AI is also used in a lot of other areas, is it a similar kind of thing where it's the people aren't, like with Go, like you said, it's not that they had a bunch of experts on Go come in and say, oh, here's the 20 principles you should follow. Go do that, my son. That's not, it just like experimented and did random stuff and just saw it in practice. So is that partly when we say AI is advancing in all these areas? Is it that kind of is that a necessary component or not even necessarily?
Yeah, with the current generation of AI, that's what you're seeing.
Okay.
So with ChatGPT, you have an architecture called transformers. So it's a type of deep learning architecture. But yeah, it's basically just taking all the stuff that it's getting for training data, and what it's programmed to do is to try to predict what the next word is, or letter, or token. It's referred to as a token, but that could be 2 letters, 3 letters, whatever. So it's just trying to predict the next letter and whatever, or character that's going to come out, space, period, comma, A, B, C, D, E. And so over time, it gets good at trying to predict it based on the input data that it has. And so when you're actually interacting with ChatGPT, it's basically got this loop running where you put something in and it will start to read it. And based on all the stuff that it gets, it's trying to predict whatever the next letter is going to be to get that response. And as it generates one, it feeds back into itself. And so it will generate the next one and the next one and the next one. And so it has, a large context of, I forget what it is, like 3,200 or 32,000. I forget what the exact order of magnitude is, letters that it takes in at a single time, or characters. And we'll just feed through that, and it moves like this window across and says, okay, given all this context that we have, what's going to come and happen next. And that's really the way that it's working. It's not been taught, hey, this is what a noun is, or, any rules of grammar, or trying to figure that stuff out. It just does it based on the training data that it's seen. So it's very similar to the reinforcement learning approach, where it's just, hey, do random stuff to begin with, but then eventually you're going to get a reward. And then your task is to figure out, okay, how do I get more of that reward? And you don't really know why necessarily or what happened, but you eventually learn over time, if I do these steps throughout these states, I wind up getting a reward. And so you can be winning a game of Go. It can be, reducing cost or maximizing profits, or, whatever it is that you do. So yeah, it's really dumb in that sense. It doesn't know what it's doing. It just does it, and because that's what it's been trained to do. And it's just optimizing an objective function at the end of the day.
Okay, great. Do I have you, Christian, for 10 more minutes?
Yeah, that's fine.
Okay, all right, yeah. Why don't we set that as a constraint? Like with Go and chess, we need to have a time limit. Otherwise, I will take it indefinitely. Okay, so maybe can you speak a bit to? Well, I got one question for you. Is there had been a lot of advances. I think in talking with various people about the large language models, which ChatGPT is the one most people know about. I think that there was a rapid amount of improvement that kind of caught people by surprise. That like if you had asked people, I don't know if this is exactly like in 2015, how soon do you think it's going to be at a point where regular people are just going to be able to have a conversation for a couple minutes and not realize that there isn't a computer? I think that they were caught by surprise. So number one, do you agree with that? That even people in the thing, or and then also, have there been similar advances in these other areas that aren't directly about large language models?
Yeah. So I mean, I was caught off guard with how big of an improvement GPT-3 and 3.5 and 4 and so forth were. I had downloaded the GPT-2 model and played with that. So that was 2020, I think, is when that was released, and I was actually planning to make a chatbot that would, based on Murray Rothbard's writings, and make a Twitter bot so that you could ask it anything and it would go. And so I had trained it and gotten some other stuff, but I was in the middle of trying to finish my PhD. I was trying to get my dissertation done that year. And so I put a lot of those side projects aside. But,
and also there were a lot of human people on Twitter that could just parrot what Murray Rothbard said. So there was still a cheaper,
but it was fun. It was
right.
And so working with that system and putting some weeks and some hours into it, I learned that it's going to throw out some crazy stuff because it was even more stochastic feeling than you get from GPT-4, where it will make stuff up and it will just kind of go off on this tangent into these different areas where you're like, yeah, that's not right. So it needs some like human intervention.
So I got into it, I think at 3.5. So at 2.0, it still sounded like it was speaking intelligently, but it would just, is confabulate the word? I forget what that word is, where it just like makes stuff up.
Yeah, it would make stuff up and it would go off. So I wound up actually changing my project a little bit. And so I made a self-help bot and I trained it on a bunch of like, whatever Oprah's book club was and, whatever kind of self, because it was a bit mushier, it was something that it was easier. And so that became actually passable for a lot of people. And so it was funny just seeing some of the interactions that I would get with that. And then again, I wound up dropping it pretty quickly because other priorities. And, but it would still like, even then it would just kind of make stuff up and it would get in these weird loops where it would just like kind of repeat itself over and over again. Okay. Where it was just trying to predict it, in its training data, it had seen this kind of phrase and it would just start over and over and over again and keep on going in those loops. So it didn't work out great. And then GPT-3.5 came out last year and it was just, wow, this is really cool. And there have been a couple of other things like GitHub Copilot. So this is something for coders. You can get as a plugin for VS Code, and it's all basically trained on GitHub and a ton of code that sits up there. And it will. I started playing around with that. I'm like, hey, this is actually pretty useful and pretty helpful. That was kind of my first inkling that this stuff is getting better. But that was on a narrow domain of writing code across many different languages, but still like a narrow domain. And it was like, hey, this is typically like at least sometimes there'll be some errors and such, but this is useful. And then GPT 4, 3, 5, and 4 came out, and that was a whole new level than we had seen before.
Okay, and now is it? I know some of the big boosters in this area, they're saying it's going to accelerate because now that there's the proof of, and now people are interested in it. A ton of money's getting poured into this stuff now. That wasn't the case 3 years ago, and so they expect that each year is going to bring even more improvements. So do you agree with that? Or is it kind of like, well, it's just, we don't know because it's just these things that it's hit or miss. We don't know what's possible.
Depends on what you mean. Yeah, by improvement. Because I think a lot of people look at it as it's going to be like an exponential Moore's Law type of improvement. I'm more skeptical about that because even with GPT putting a bunch of stuff out there now, the training data has been the internet, right? And so now a lot more of it's being written by these models. And so the models are pretty good. But are you really, by training it more of the same, are you really going to improve it? I think there's got, are you also going to be starting to run out of, training data in some respect? Like, yeah, you can kind of have this self-referential feedback loop that's going through from, these large language models, but to get the high quality data, that might be a little bit of a concern. And plus, these things have gotten larger. Like if you actually see the size of them, they've increased exponentially in size. So you mentioned, some of these have been trained on trillions of bytes of data and or tokens or whatever. I forget the specific measurement that they typically use for it. I think it's tokens, but trillions of tokens, and they're now billions, hundreds of billions of parameters. Whereas just a few years ago, you're talking about hundreds of millions of parameters or tens of millions of parameters. How much longer can that go? That you just get it bigger and bigger and bigger and bigger. I would think that you have to start hitting the area of diminishing returns by just kind of refining the same technology. I think, maybe getting more money into it, you might get a step change, which is kind of how this technology was. It was a big step change originally back with the first deep learning revolution kicked off in 2011, 2012 in computer vision, because all of a sudden you had, very manual hand-tuned models that were getting, say 70% correct on vision image classification. And then deep learning came along and now it's, 90 something percent correct. And then it got better and better up to 100. I think it's going to require that kind of innovation again, but that's just kind of armchair theorizing at this point. So I don't know how much I'm not going to bet majorly on where it's going to go from there. But I think the applications are really going to start to fill out. But the underlying technology, I'm not sure how much farther that's going to go.
Okay, it does make sense. Last question, and I'm riffing. I would credit them. I just can't remember who I saw it from, but someone who's really into this stuff showed me this other podcast, and the guy raised the question. He, the podcast host asked the guest who was an expert in this stuff, so I'm asking you now, saying, suppose, just to kind of get a handle on like the innovations versus the adoption, suppose right now it just capped out and, ChatGPT, what is it, 4 right now, or is it 4.5? I don't know. That just stopped. And the existing state of AI is what it is. But now we just let the clock run and let companies realize already what AI can do and figure out, how do we apply this to our supply chain? How do we apply this to our, employee compensation program, to whatever, customer retention, blah, 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 or marketing. And you just let that play out. Do you think there's GDP growth would be doubled for the next few years as everybody incorporated it, or it would be, anyway, do you get the question I'm posing and just try to figure out?
Yeah, and that's where I'm more bullish on the technologies, from taking what we already have and applying that. And I think that's where huge gains can be made in automating a lot of processes, streamlining a lot of processes, being able to, for lack of a better term, democratize, coding capabilities and information processes and so forth. Because when you get inside of a lot of these companies, especially these big, older companies, you find that there's just a lot of legacy stuff where, coming from a computer science, AI type of background, you're like, wow, we could do a lot better, but the people don't have those skills. So if you can have a co-pilot or something there that's sitting alongside them to be able to help them, understand the data. So it's not all just like these terribly run Excel sheets and so forth, but they could query it, ask questions, and really see how, have somebody to somebody that's an expert, or at least better than them, to work with and get back and forth feedback. You can start to improve a lot of stuff. One of the frustrations I've seen is I use ChatGPT, and the prompting really makes a big difference, how you use it. And I've given it to a lot of people, and they'll just, ask a question like, oh, write me a paragraph about X. And it's terrible. It makes up stuff, and it doesn't meet anybody's requirements. And then they come back, they're like, why did you tell me about this? This is awful. It was wasted time. I'm like, you didn't use it right. You just wanted it to create a bunch of stuff. You actually have to think about your problem, what you're trying to solve. You have to give it, a lot of stuff. So I've got a friend who's trying to finish his doctoral thesis in theology. And so he asked me about it. I was like, don't ask it to write stuff for you. Ask it to edit. It will do that really well for you. Give it ideas, ask it to organize your notes, ask it to organize, some other stuff, and it will do a really great job. And it, once he started doing that, he got the gains out of it. Before that, he was just like, it's just making stuff up. This is terrible. It's actually adding work, because now I have to cross-check everything it gives me. So how you use it, there's going to be a learning curve. And I think companies are starting to wise up to that and starting to build interfaces. They're starting to link it to their data internally, so that it can start to be augmented with document retrieval that they have within their own databases, within their own intranets and systems, and company knowledge. And once you start to bring a lot of this stuff together, I think it's going to really boost the productivity and capability, and maybe get rid of some jobs, which is going to be troubling for some people, but they'll be able to move on and do other things. I've never talked to a manager who says, I've got too many resources. They always want more because there's more stuff to go and do. And I think that's where a lot of that growth is going to come from. How long that's going to take to play out, I don't know. But
yeah, I mean, the promise, this is the last thing I'll say, and then give you the final word if you want it, Christian. Yeah, what I think people are failing to see is that when everyone gets their heads wrapped around this, there's a sense in which every company can have 1,000 virtual employees who are, telecommuting. So they're not there physically with their hands moving stuff in the warehouse, but they're thinking and sending stuff electronically, and they never go to sleep and they never make a basic mistake. And, they just require some electricity and some, computer power, and they don't have to eat. And they can, could you use 1,000 employees like that, in a sense cost 18 cents per hour or whatever it ends up being? I don't know, making that up. But, and I think some businesses maybe not, like professional sports in terms of guys going out in the field and hitting the baseball. No, you can't have the AI go out and do that on the field. But even the back office, the people reviewing the games and how should we,
the trainers,
upcoming team. Yeah, there you could. But I'm just saying that there's plenty of businesses right now that use employees, some of whom telecommute, so they're not physically there in in body form. They're relying on their minds. And so, yeah, could you use potentially thousands of employees like that have a pretty low amount you'd have to pay per hour of their time? And I think a lot of businesses haven't even thought like that yet. They're just like, oh yeah, this is a kind of a funny thing that can generate, poems or something in the style of Bob Dylan or something. And imagine if President Trump was a rapper. This is what it would look like. Ha ha. And no, there's a lot more you can do with ChatGPT even than just that kind of stuff.
Yeah, I used it for document review for instead of paying $800 an hour to an attorney, I was able to use it for document review and say, hey, here's a contract I have. Like, go through this, give me the pros and cons, and then run it by a much cheaper attorney. And basically got as confirmation. And it's like, yeah, this is basically all I thought it was based on my interaction with ChatGPT, because I'm not a lawyer. It took me an hour of going through it, and it's a normal, too much attorney, an hour, and saved tons of money for me and tons of time. And I understand a lot better what I'm signing, what I'm doing, stuff like that, where you have standard forms that you can have filled out, and you can maybe even tweak them and make them a bit more customizable based on AI's capabilities, in the insurance industry, in the finance industry, a lot of these professional services and so forth. I go there instead of Google now for a lot of first pass on, like, hey, my kid is sick. Here are the symptoms. Like lay out what the possibilities, do a differential diagnosis of what this is going to be. And, it's not always 100% correct. You got to go check all the references and so forth, but it'll get you going and get you going down the right path.
If you use the Murray Rothbard chatbot, it would say cut taxes and use gold as money. That will fix your kid. So
yeah, basically. So you don't want that specialized Murray Rothbard for everything, but it would be nice.
Yeah. Okay. Well, thanks. I've kept you way over time. I'll stop here, folks. My guest has been Christian Hubbs. Christian, thanks so much for your time and your insights.
Yeah. Thank you. It's been a pleasure.
And thank you everyone for tuning in. We'll see you next time.
This concludes another episode of InFi, the Future of Finance, with Dr. Robert Murphy. The information provided is for educational purposes and does not constitute financial advice. Consult with qualified professionals before making any financial or investment decisions. For more information on the host and for previous episodes, visit InFi, thefutureoffinance.io. Thanks for listening.